Hello, I am John Najarian, and RebelCon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at RebelCon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
And happy Thursday, Market Rebels. Well, we've been struggling ever since the CPI came out on Tuesday. I think we closed down about 1% or so on the SPY. Didn't see the actual close. Little bit of a bounce, little of half-hearted attempt yesterday, but boy, what a sell-off on Tuesday at 8:30 when the CPI came out. One thing I will never, ever understand about the markets is when these economic indicators come out, because they're always reported as a range. That's how all statistical data is reported. It's the science of uncertainty. And so they report it as a range, but the midpoint, the halfway point, is really what the media says is the expected number. So they came in, they said it was supposed to be minus 0.1% for month over month. It came in at plus 0.1%. Well, is that a big difference? Well, it depends on the range. The consensus range was minus 0.3 to plus 0.2. So plus 0.1 is right there in that range. And yet they absolutely freaked out. But the point is, it can also mean that it can reverse, because these are statistical samples, and depending on the draw, it just adds to the volatility. We were at the high side at about 8.3%. That was the top of the range, and the report as well for year over year. So again, more volatility in the markets, but we'll just have to keep watching. But that's why we trade options. And today we're going to talk for trading tune-up. Another interesting little topic. It's a little quirk in the markets that a lot of people don't know about, but usually get stuck by surprise. And that is, why isn't my vertical spread filling? And this goes even for a market order. We're usually taught that a market order is guaranteed to fill. That's mostly true, but it's not always true. And this is one of the cases. So why is that? How could you possibly have a market order in, let's say for a vertical spread, and it doesn't get filled? And so traders are scratching their heads going, what's going on here? Market makers must be trying to rip me off. And they end up making bad decisions. Well, here's the reason that it's possible that these are not going to fill near expiration, even with a market order. There we go. So first of all, remember that we have two basic types of orders. And we have a market order, which, as I just mentioned, is guaranteed to fill, but it does not guarantee the price. All right, so you know it's going to get filled, you just can't be 100% certain about the price. On the other hand, you can place a limit order, and that's where you have to submit the price, what's called your reserve price, and that is guaranteed, but not the fill. Now, when I say guaranteed, it doesn't mean that that number that you submitted is guaranteed, but it means if you are the buyer, you will not pay more than that. So if you put a limit order to buy an option at 5, it cannot get filled for more than 5. It could be 5 or higher, but it could also be lower. The exchange is assuming if you're willing to pay 5, you should be happy to pay 4.90. So it doesn't mean it has to get filled for exactly 5. Sell limits work in a similar way. If you had an order to sell at 5, it could be that price or higher. But those are the limit orders. Now, near expiration, though, Doesn't even have to be expiration day bid. As you get pretty close, it's not uncommon for traders to buy back, let's say, a short vertical with a market order, but not have it fill. And they're just, again, going, what's going on here? Why is this happening? So that's the first question we want to answer is, why are they not filling? And number two, what should you do about it? So let's take a look. Here's an example. Let's say we sold a $100 call and we bought the 105. Now, this is a credit spread. We've talked about option pricing principles before. Remember, for call options, all things being equal, the same expiration month, lower strike calls are worth more money. So if you're selling the 100 call, it's got to trade for more money. So we know this is a credit spread. We're buying the 105 as a hedge. We talked about that with cheaper chicken. You don't want to sell that call naked, so you come up here and you buy that 105 call. Let's say that this is executed for a net credit of 3. And then we would have the potential, we have a $5 liability. And the most we could make is 3, the most we could lose is 2. And what you'd like to do whenever you sell a spread is to see it expire worthless. That's the best case. Or at least to buy it back at a lower price. So maybe we sell it for 3 and buy it back for 2. Or buy it back for 1. Again, the best scenario is that we don't have to pay anything for it. So here's what this spread looks like. Selling the 100 and buying the 105. As always, I talk about we get a bend at our strike. So there is a strike at the 100, at that bend. We get another bend at 105. So if the stock closes at 100 or lower, up here, we're going to get 3. That's our maximum gain. But if we close out here at 105 or higher, we end up at our maximum loss. So this is our risk graph. Again, it's a credit spread with calls, so it will be bearish. So this is our trade. And now, let's say we're getting near expiration. We've got our 100, 105 short, and we go, okay, I'd like to buy it back. And we look at our broker's platform, and it says bid 10 cents, offered at 30 cents. And so you go, okay, hey, I sold it at 3. Let me buy it back for 30 cents. I don't even care if it comes in plus or minus 5 cents. I just want to get it filled. So you place this order to buy it at market. So normally that's going to be a couple of seconds, and that trade's going to execute because, again, it's guaranteed to fill. You're just going to lift the offer. If you're selling, you're just going to hit the bid. You're just taking the next person in queue. So those are guaranteed to fill. But for some reason, you're sitting here watching it, and it just sits there and sits there and sits there. And you're going, why is this not filling? It's a market order. Here's what could be happening. And this is why, in this case, that you need to break these apart and look on your broker's platform at the individual quotes. What I'm assuming right here is that we're looking at the vertical spread quote. You could buy it right now, or the market makers are trying to buy it for 10 cents and sell it for 30 cents. As a retail trader, you could buy it for 30 cents and sell it for 10. That is the quote for the vertical spread. But let's break them apart. Let's go to the individual option quotes, and let's say that the $100 call has a bid of 20 cents and an asking price of 30 cents. And the 105 call has a bid of 0 and an asking price of 10 cents. So how did we get that quote from the previous screen? Well, here's where the quotes come from. Here's where the 10 cents to 30 cents comes from. To sell the spread, you would have to sell the $100 call, which you currently could do for 20 cents. And then you could buy the 105 for 10 cents on the asking price. And that's where that 10-cent bid is coming from. These vertical spread screens, there's nothing magical about them. They're just pulling the quotes from the individual screens. What about the asking price? Well, if you wanted to buy this spread right now, you would pay 30 cents on the asking price to buy the 100, and you would sell the 105 for 0. And that's where your broker's platform is coming up with 30 cents. Now you can see the problem. You have no bid. There's no buyers. So the broker's saying, okay, yeah, I know you want to buy this at market, but in order for you to buy it, I'm trying to sell this. I'm trying to sell this 105 call, and we have no buyers. That's why your trade is just sitting out there. So what do you do in a case like this? Well, again, this is why you have to go into the individual quotes and look at them. And if you see that there's no bid, it's a very easy problem to solve. So obviously, it never makes sense to close a long option for no money. So what do? just close the short $100 call. There will always be an asking price. Okay, you can always close that one and just hang on to the other one that is a lottery ticket. Remember that 105 was long. Chances are it's going to expire worthless, but hey, you weren't going to get anything for it anyway. So why would you sell it for zero? Just let it sit in the account. Who knows? Maybe there's going to be some bizarre announcement after the closing bell and the stock is trading up to 130. You're going to really regret letting it go for zero. So yeah, if it's not going to fill because there's no bid, no problem. Just close out the short position and hang on to the long. And so that's the way that you resolve that. So always remember that a long option worth zero can never hurt you, but it could certainly become valuable. It's really the opposite of a danger that we talked about with risks versus dangers. Dangers are positions that could do a lot more damage. They can't really make you a whole lot, but they could certainly hurt. This is the opposite. It can only help. So if you happen to get stuck with a vertical spread, which I know a lot of people are trading in these markets because of the volatility, and you're trying to close it, this is a very common scenario. Now, the reason I did a short vertical is because that's usually where that higher strike is going to be no bid. You're not going to see a quote there and a zero bid on the more valuable option. But regardless, if you find that a market order on your vertical is not filling, go look at the individual quotes. And if that long option has a bid of zero, that's the problem. Okay, so again, the thing to take from this is that it's so important to understand the options, not just to memorize strategies. And so hopefully this gives you some more food for thought. So with that, as always, we'd like to invite you to a free one-on-one consultation with one of our world-class coaches. The phone number is 888-809-8058. Talk with you about any topic you'd like, but it's amazing the amount of insights they can give. Again, a lot of these guys have had decades of experience on trading floors and in market-making centers. They can transfer that information over to you very quickly. It's worth its weight in gold, and this is absolutely free. So give them a call, and I hope that helps, and we'll look for you tomorrow, 4 p.m. on the closing bell. Thank you so much.